I give a program on managing your own, we call it managing your own portfolio. It's basically a portfolio management program for individual investors. I've done it 3 times this year. It's in very high demand, as you can imagine. And basically what I do, it's a 1-day program or a 2-day program. I have done both formats. And one of the things I try to tell people is, you know, when most people think about investing, they're always thinking about predicting. They're always thinking about, you know, what I should buy, what is going to perform well, what is going to perform badly so I stay away from, what is a good time to get into the market, what is a bad time to actually get into the market. They're always thinking about predicting the next big thing. One of the main messages that I hope they get out of my seminar is forget about predicting, focus on strategy. Focus on asset allocation. That's the very important thing. And at the end of the day, most of the evidence shows that asset allocation is a far more important driver of returns than market timing is ever going to be. So this distinction between predicting and engaging in asset allocation is actually very important. One of the other things that I say, and this is something that a lot of people don't like to hear, is that, you know, in the market, in the very efficient markets with so much money at stake and so many people and so sophisticated in the market, it's very difficult to find free lunches. I'm not going to say impossible. Maybe, you know, we walk on the street, we get lucky, we find a $100 bill. It's not impossible. But, you know, I wouldn't try to make a living out of walking the streets and trying to find $100 bills. Now, this is a little bit of the same thing. When someone comes to me as a client, they're always invariably looking for the great strategy, the one that gives them a huge return in 1 week with no risk. You know, I wish I knew. I just don't. And so I always tell them what I call the 2 sad truths of the market. And number 1 is the more return you want, the more risk you have to be prepared to be exposed to. There's a trade-off here and you can't avoid it. You want more return, you need to be exposed to more risk. Truth number 2, or sad truth number 2, the more exposure you have, the higher the risk of your portfolio, the longer your investment horizon must be. Because we have an issue that we even give a name to in finance. We call it time diversification. This means that the longer the investment horizon, the more likely it becomes that the relatively riskier asset is going to outperform the relatively less risky asset. And what that basically means is that if you take a very risky position for a very short term, well, it may pay off greatly, but it actually may pay off really, really badly. That what maximizes the probability that a risky position is going to pay off is a long investment horizon. Now, most investors, when they think about their portfolio, they tend to think in terms of risk and return. And I always tell them, never forget the variable in the middle. The investment horizon is absolutely critical. A portfolio that may be very convenient for the short term may be very inconvenient for the long term, and also the other way around. So those are things that are consistent with this. That it all depends on the investment horizon. What should we do in times like this? So if your term is relatively short, well, I hope that these numbers convince you that trying to time the market, you know, if you want to play the game that you find exciting, it's okay, but I don't think you're very, very likely to get the timing right. The second thing is what some people call pessimistic, but I think that this is just the way it is. The shorter your investment horizon, the more you need to seek protecting your capital. The longer your investment horizon, then the more you can actually search the upside of your capital. But in a short investment horizon, there are no tricks. You know, you can't go into the market today and expect to actually do great between this week and next week. These are very volatile markets. If you have a long-term investment horizon, this may be a great time to invest in the market. Just to give you an example, the PE ratio of the Spanish market right now is about half of the historical PE ratio. So you can go into the market in a very cheap market, if you will. That's going to pay off if you have a long investment horizon, but it may not pay off at all if you're looking at what's going to happen to your portfolio next week or next month. You can still get scared a lot, not only in the Spanish market, not only in the US market, I would say in just about every market, just about every asset today. So in the short term, the message is, don't try to gamble the market, particularly when markets are this volatile as they are now. Just protect your portfolio, have a high exposure to bond, a little exposure to stocks to preserve a little bit of upside, and don't expect any magic from financial markets. Now, if you have a long-term horizon, then this is what most people find very difficult to do. And I think that one of the problems here, and I'm sure you have gone through this before with your portfolio or thinking about it, is that we all tend to look back and say, we should have cashed out at the beginning of the year. Well, looking back, it's always easy to say when we should have cashed out and when we should actually cash in. The problem is that, we have a lot of evidence, we look back, and it's always very easy to pinpoint good time, bad time, good time, bad time. The problem is looking ahead. That is, what should we do right now? Is the market going to go up and down? I have no idea. I think that in the long term, as they've always done before, not only the Swiss market or the US market or the Spanish market, just about every market, they typically go down. But in the short term, you might as well flip coins. I couldn't tell you any better than that. Now, doing nothing, what does that mean? Well, it doesn't look like a great strategy when you lost 40% of your portfolio. But again, that's a sunk cost. It already happened. So now you have to focus not on what you should have done at the beginning of the year, but what you should do today. And again, a good strategy at this point in time might be simply to do nothing. It takes a lot of guts, it takes a lot of courage, it may not be easy to implement. The analogy that I want is, some of you might have gone through this, maybe not in Geneva, it's too organized a place, but if you were like me from Buenos Aires, you're going across the street and this guy with a motorcycle comes running and he says he's going to hit me. Now, most people tend to say, I go left or I go right, to avoid this guy. The problem is that if you go right and the motorcycle goes to the same place, he's going to hit you. And so it's kind of 50-50 that maybe you go to one side and the motorcycle gets to the other side. Best thing to do, and this has been told me by one of the persons that I know that run over most people with a motorcycle, is do nothing. Just stay. We on the motorcycle, we can avoid you. But if you actually happen to guess wrong, then it's going to be bad for you. Now, that's exactly the same. Doing nothing, just staying there and hoping that the motorcycle avoids you, takes a lot of guts, takes a lot of courage. It might be the right thing to do.